Hello, welcome to 3.3 Decision Making Techniques. This is one of the areas of Theme 3 that students find the most difficult, mainly because of the latter three topics in this unit: investment appraisal, decision trees, and critical path analysis. They both, well, all of them require extensive amounts of calculations and can be quite tricky if you don't come back to them on a regular basis. Quantitative sales forecasting is the first topic in this unit, and actually, if you watched the Theme 2 video about sales forecasting, I typically teach them very similarly. So with quantitative sales forecasting, we're mainly looking at the numeracy side of things in terms of sales forecasting. So rather than thinking about the factors that might affect predicting sales, we're looking at the numeric side of things. So there's the correlation between two variables, and you would look at that on a scatter diagram, and you would be looking at, first of all, whether there was a positive and negative or no correlation, but you'd also be looking at how close to the line of best fit, if you do a line of best fit through there, how close to the line of best fit the data points are, because the closer to the line of best fit, the stronger the correlation is. You would be looking at extrapolation, and this is about looking at data that we have and trends that we already have and trying to extrapolate where we think those trends might continue. You can take a lot of that with a pinch of salt. I mean, you look at the example that I've got on the screen, you can see there that sales are increasing. You can't just expect that because they have in the past, they're going to continue to increase forever. But there is some relevance to doing this because it can show you the trend that you're on, and certainly if you don't have any action, where things might end up. Especially useful for when you start to see the sort of downward trend. We also have moving averages and smoothing out fluctuations in data. And the key thing with moving averages in Theme 3 is you could see this as a calculation. So you might be asked to calculate a 3-period or 4-period moving average. My best bit of advice for this, they can be quite tricky and can quite easily catch people out. My big bit of advice for moving averages would be to go into the description of this video, have a look at the exam question finder and go to 3.3.1, and you'll see some examples of past paper questions that have asked questions on moving averages. That's the best way to practice this, basically. The next topic is investment appraisal. First of all, what is investment appraisal? Investment appraisal is a way of assessing whether an investment that a business is going to make is a good financial decision. So you think about this. This is mostly used when there's significant investments at risk and large amounts of money, and you want to try and identify the likelihood that it's going to be successful, but also, how is it going to make its money? How quickly is it going to pay back, etc. So this would be used if a business was, for example, maybe buying new machinery or buying or expansion, launching a new factory or launching a new range of stores or something like that. And there's three methods in investment appraisal. We've got payback period, average rate of return, and net present value. So payback period is how long it takes for the investment project to recoup the initial cost of the investment in the first place. Average rate of return, payback period is probably the most easy one to get your head around concept-wise. Average rate of return is how much of the investment cost, so how much of the investment that we've spent on this project, do we get back as profit every year? And so hopefully when you see the examples, that one will make a little bit more sense. But effectively, it's a measure of profitability from a project. And then net present value, conceptually, is probably the trickiest. It takes into consideration the fact that money in the future is not worth the same as that same sum of money now. So, for example, if someone came up to you and said you can have £100 now or you can have £100 in a year's time, you're better off taking it now, because if you have that money now, you've got the opportunity to do something with it. Whereas if you don't receive that money for a year, you can't do anything with it for a year. Even if you took it and just put it in a bank for a year, because of interest, you'd have more money than the £100 in a year's time. And so with that in mind, future cash flows, so money you're not going to receive for 5 years, is not worth the same as that money value now. When we get to that part, we'll talk through that in a bit more detail. Now, we need this table for investment appraisal, and we're going to add a little bit to this table in a short while when we do net present value. But for payback period and average rate of return, this is all we really need. And this could be set out in a few different ways. You might not get cash flow. You might get cash inflows and outflows, and therefore have to work out cash flow yourself. You might get cash flow given. But the general concept here is we've got years 0 to 4. Year 0 means right now, like today, so the beginning of year 1. Year 1 means at the end of year 1. Year 2 means at the end of year 2, etc. And then our cash flow is effectively how much money this project has cost us and generated over the course of that year. So if we look at year 0, in this situation, let's imagine that our project cost us £1 million. These figures are all in thousands, so 1,000 is 1 million. We put this in brackets because that shows that's an outflow. We have basically spent £1 million on this investment. But over the course of the first year, we've received a cash flow of 180. And so that would mean that would be our cash inflows, subtract our cash outflows. It's effectively our net cash flow for the project. In year 2, hopefully as time goes on, we'll make a little bit more money from this project as it becomes more established. In year 2, we make £330,000. In year 3, we make £320,000. In year 4, we make £460,000. So this cumulative cash flow, cumulative just basically means like a running total. So we're going to start with our minus 1,000. And this is what's going to allow us to calculate our payback period. For our payback period, we need to figure out when our cumulative cash flow becomes positive, because that's going to allow us to determine when we've received our £1 million back. So at the end, on year 0, we've obviously spent £1 million. At the end of year 1, we're now still in debt to this project. We're still on minus 820,000, but we have made £180,000 worth of progress into this. I've put it in red because at that point it's quite clear we still haven't paid back yet. We still haven't recouped the whole £1 million. By the end of year 2, we've generated another £330,000 in cash flow. So we would be sitting at negative 490. So we're just kind of adding these to our total as we go through. So we still haven't paid back. We're still in the negatives, but we're closer. At the end of year 3, minus 170,000. So we're still not there yet, but you can see that we're making progress. And then by the time we get to the end of year 4, we're into positives. So by this point, we've made our £1 million back. We've got a profit on this project of £290,000. And so we've reached that payback period, not at the end of year 3, but by the end of year 4. So we've reached it in 3 years and something. And what we need to do is we need to work out what the something is. So how do we do that? Well, this is where we'd use that little formula I've got on there. It's not the most scientific formula. It's not the easiest one to remember, but the concept of it effectively is at the end of year 3, how much money do we still have to make in order to reach that point where we hit 0? And the answer is 170. So that's our last negative cumulative cash flow. How much do we make the following year? So if we need to make 170 during the 4th year to reach payback, and we make 460, effectively we're working out how far into that £460,000 did we reach 170. So if we do the last negative cumulative cash flow, so 170 divided by 460, and we times it by 12. Reason we times it by 12 is to figure it out in months. We should get 170 over 460 times 12 is 4.43. So that means it's 4.43 months through the 4th year. So the payback period is in 3 years, 4.43 months. Now that's not really a perfect model, to be honest, because that's assuming you're going to make the exact same amount of cash flow at every single month throughout the year, which, isn't necessarily realistic. You're probably going to get different levels of sales in different months depending on your product. And just generally, that's not how business kind of works in reality. But it still gives you a bit of a model. So you would look at this and you would, I guess the key thing here is it depends on how quickly you need the money back. If the business has a cash flow focus, then they may wish to prioritize a quicker payback period. That might be the most important thing. Ultimately, I guess the main thing is that it does actually pay back. So you could, for example, have a situation where it doesn't actually pay back, and in which case, over the length of the project, it's not actually recouping the investment. And obviously, from a start, that's going to be just a no-brainer. You're not going to bother going with that project. The second of these is the average rate of return, and this one does have a more kind of clear, easy to understand formula, but the concept's a little bit more tricky. For this formula, we are looking at the average net profit. So we're going to do net profit divided by the number of years. So in this situation, that's going to be £290,000 in net profit. The project lasts 4 years, so 290 divided by 4. And then we're going to divide that by the investment cost and times it by 100 to get a percentage. So we should have 290 divided by 4 divided by 1,000 times by 100 gives us a figure of 7.25%. Now what that means is every year of the 4 years, this business makes 7.25% of the initial cost as profit. Now that's obviously a good thing, because if this figure is positive, it means that your project is profitable. and you're getting effectively 7.25% of your initial investment cost each year as profit. So over the course of the 4 years, that's going to add up to £290,000. But you would, if you're, you might have a target for this, and you would want that target's going to be, you want to be pretty high to that target, basically, because the higher this is, the more profitable your business has become, your project has become. The final step in net present value, which is the one I mentioned earlier about the consideration of future values of money, is net present value. And so in order to work out a net present value, we basically need to discount our cash flows. What I mean by that is we have to quantify the fact that the money that we receive in 4 years' time is not worth the same as it would be if we had that money now. So if we look at year 4, year 4's cash flow is £460,000. What we're effectively saying here is that £460,000 that we're going to receive in 4 years is not worth as much as if we had £460,000 now. Because if we had £460,000 now, we could invest it, we could use it to hopefully turn it into more money. So we're going to apply all of these cash flows by a discount factor. And the key thing here is the further away we get from now, the less valuable that money is. So these discount factors are going to decrease the value of this money more significantly the further away we go from present day. So this is our table. We're going to look at a discount factor column, and we're going to add a net present value column. We'll talk about net present value in a minute, but for now, let's focus on the discount factors. Year 0, we're going to go with a 1 discount factor. That's today. So that money is worth exactly the same. So times it by 1 is effectively times it by 100%. After a year, we're going to say it's effectively 90.9% of its value. So we're going to times it by 0.909. After 2 years, we're going to say it's even less valuable. That 330,000 is worth much less than 330,000. It's worth, well, effectively 82.6% of that. So we're timesing it by 0.826. After 3 years, 0.751. And after 4 years, 0.683. So you can see there that we are discounting these cash flows by more the further away they are from now, because money in a year's time is more valuable than money in 4 years' time. The discount factors are given to you. You don't need to know them. You don't need to memorize them. They will be given to you in the exam. To be honest, if you see them in the exam, you know you're going to have to calculate net present value. So there's the big clue, basically. If you see that, you're going to have to calculate this. And the formula is pretty straightforward. You just take your cash flow and you times it by the discount factor. One thing that's worth really being careful about, don't times your cumulative cash flow by this figure, times your cash flow by this figure. So minus 1,000 times by 1 is going to be minus 1,000. 180 times 0.909 is going to be 163.62. So what we're saying is that because of that cash flow, that £180,000 is in a year's time, it's not worth £180,000 to us. It's worth the equivalent of £163,620 to us. The 330,000 in year 2 is worth 272,580. The year 3 figure is worth 240.32, and then the year 4 figure is worth 314.18. Now, the final answer we need is just by adding these all together. So if we add together all these net present values, including the negative, we should get a total, in this situation, of negative 9,300. What that basically means is that this project, when you take into consideration that future cash flows are not worth as much as they are now, has a negative net present value. So that might be a reason why a business may not go with this. Effectively, you're more likely to have a negative cumulative cash flow if you don't make very much of a profit on the project as overall. So when it's discounted, that profit just disappears. Or potentially if you receive the vast majority of your cash flow really late on in the project, so you get most of your money back in the future, like quite significantly in the future. That's the case in this one. So the biggest cash flow we get is in year 4. Well, year 4 is also the least valuable cash flow in terms of current value because it's so far away in the future. So in this situation, minus 9,300, it's not a huge amount negative, but it is still negative. And so a business would use those measures to try and identify whether their project is worth doing. And so you could see that in a essay question, usually going to be on paper 3 if you see it as an essay question. You could see it as a 4-mark calculation, but make sure you know how to calculate these. The best thing about this is if you just change the cash flows, like if you change that column of cash flow figures and you start with a negative and then you do some positive cash flows below that, as long as your positive cash flows add up, like so years 1, 2, 3, and 4, as long as they add up to more than the cash flow in year 0, then you should be able to work through all of these calculations. And so you can practice that as many times as you want, but it's well worth having a look at past exam questions on investment appraisal to get an idea of it. It's just one of those things where once you've gone through the process a few times, it's actually pretty straightforward as a process. You just need to know what you're doing. And hopefully this has helped a little bit. Decision trees and critical path. These are the ones that have kind of diagrams to follow. So this is, the decision tree one's pretty straightforward actually, but when you haven't looked at it for a while, it can be quite daunting. A decision tree effectively looks like this. So we've got a series of decisions that a business needs to make, and we've got the chances of potential outcomes. So if we take the square, for example, this is the decision, and we've got 3 options here. We've got the new product, to launch a new product, and that little number underneath that costs, that's the cost. So to launch a new product costs £6 million. We've got entering a new market, and that could be like taking an existing product into a new country. That's going to cost £8 million. You'd expect going into a new country maybe a little bit more expensive. And then we've always got the option of doing nothing. We'll talk about when that might be useful in a little bit once we've done some of these calculations. So those are our decisions. And when we make these decisions, there is a chance that these decisions provide an outcome. So with a new product, it's either going to be a success or it's going to be a failure. Sometimes you might see 3. So for example, you might see success, high success, medium success, low success. But in these ones, to just keep it simple on this example and for the benefit of fitting everything onto this slide, we'll just do the 2. So let's do success and failure. So in this situation, we have 0.8 success, 0.2 failure. That represents percentages. So that's effectively an 80% chance of success and a 20% chance of failure. The new market is a little bit more risky. So we can see that reflected in the fact that there's a lower chance of success, 60% chance of success, 40% chance of failure. The other thing we need to know, though, is what this success and failure will actually look like in terms of financial reward. So for the new product, if we say that success is going to generate 13 million, failure is going to generate 4 million. For the new market, success is going to generate 18 million, failure is going to generate 8 million. So that's not too bad. The failure still recoups your cost, but it's not considered a success. Whereas with the new product, if we fail, we actually generate less money than we've spent, which potentially could be a problem. We'll figure it out. There's 2 calculations we do here. The process is really straightforward. We're going to do them for new product and for the new market. So the first is called our expected value. And this is effectively when we look at the outcome for a new product, for example, if we look at the 2 potential outcomes, we want to calculate a weighted average to identify if we did this in a simulation, we did this 100 times, what would the average outcome be? The expected value of this decision. So to do this, we just take our outcomes and multiply them by the probability. So 13 times 0.8 is 10.4. 4 times 0.2 is 0.8. And if we add them together, we get our expected outcome. So 11.2 million. And what that means basically is that if we did this 100 times, on average, we should receive about 11.2 million. The thing is, you're never actually going to receive 11.2 million because it's either going to be a success or it's going to fail. And to be honest, this is all based on projection anyway. So you're not necessarily going to get 13 million if you are successful. You're not necessarily going to get 4 million if you fail. But it's a tool for use for decision making. It wouldn't be the only thing you'd use. And so we get an expected value of 11.2 million if we make that decision. What we haven't considered though at this point is we haven't considered the cost. So when we calculate our net gain, we need to take into consideration the cost. So our net gain is just going to be our expected value minus the cost. So 11.2 million minus 6 million is 5.2 million. So 5.2 million net gain. The expectation there is if we choose the new product, we should get a net gain on average of £5.2 million after we've taken into consideration the cost of this new product. So what we want to know basically is whether that net gain is higher than the net gain for the other option, the new market option. So let's do the expected value first. So that's going to be 18 times 0.6 is 10.8. 8 times 0.4 is 3.2. Add them together gets us 14 million. So that is higher, but remember this was more expensive. So our net gain is going to be 16 million minus 8 million is 6 million. So in this situation, our net gain for the new market is higher. Therefore, based on this data alone, that would be the better option. Now, that doesn't necessarily mean it definitely will be the right option. Doesn't necessarily mean that's going to work, but that's what the kind of weighted averages of this data shows. And that's how you do a decision tree. And again, as I mentioned with investment appraisal, if you want to practice this, there's two options really. You could just change the numbers on the one that's on the screen and give it another go, do the calculations. or have a look in that exam question finder, look at 3.3.3 and see if you can find any practice questions. There are some in there, obviously, on decision trees, and give them a go. The final topic in this unit is critical path analysis. Critical path analysis is effectively looking at a project over a period of time and trying to identify how long each activity in that project takes and how long the entire project is going to take, so that we can identify any areas where we maybe can have delays, maybe any areas where we can't have delays without delaying the entire project. So a critical path diagram will look something like this. There's a series of circles, a series of lines. The key thing to be aware of here is that the activities are the lines, not the circles. And that's one of the most common mistakes you see in the critical path, is when people are starting to be introduced to it. They think that the circle is the activity. The circle is the point between the activities, or before and after an activity. So we're going to number these, and these numbers don't really mean anything other than just allowing us to point to one and say node 1, node 2, node 3, 4, 5, 6. So node 1, for example, that first circle, that is not an activity. That's the point before the next two activities begin. So let's put some letters to these activities. So we've got activities A, B, C, D, E, and F, and then the numbers on the other side of the line, that's the duration. And let's say, for example, this could be in weeks. So activity A, whatever it is, takes 3 weeks. Activity B takes 1 week. Activity C takes 1 week. D takes 2 weeks. E takes 1 week. F takes 1 week. I've kept the numbers really simple for the sake of this example. But you could change those numbers to any other numbers and you'd be able to do the same thing. So node 1 is the point before A and B begin. Node 2 is the point after B is finished, but before C has begun. If we go along to the right to the end, node 6 is the point at which F is finished. There's obviously nothing coming after F. F's obviously the last activity in this project, but hopefully you can get a bit of an idea of how this all looks. So there's a process we're going to go through in order to calculate this. I'll explain the theory behind these as well, but if you know the process, then doing this is actually pretty straightforward. So the first step is to calculate the earliest start times, and they're going to go in. If you look at our nodes have got the section on the left which basically says the node number 1, 2, 3, 4, 5, 6. The other half is split into two kind of corners or two quarters. The top quarter, that's where our earliest start time is going to go, and that basically references the earliest point at which the next activity can start. So the earliest start time for the next activity. And we're going to calculate this going left to right. We're going to add as we go. And if we've got more than one option, and we'll see this, use the largest total. I'll explain why when we get to one. So we're going to start with 0. So I'm going to do these in green just so you can kind of see them easier. If we get to node 3, you'll notice that there are two paths to get to node 3. There's A and then there's B and C. So we're going to come back to that because we can't do that one until we've had a look at activity B first. So node 2 is the earliest start time for activity C. C can't begin until B has been completed. If B takes 1 week, we can't start C until after 1 week. So we're going to do left to right, we're going to add. So that is going to be 1. And then here's where we've got the two options. So we've got two pathways to get into node 3. We've got A, which takes 3 weeks, and we've got B and C, which combined take 2 weeks. So 1 plus 1 is 2. We're going to use the largest total. So we're going to put 3 in there. Let me explain why that's the case. That number there, that number 3, represents the earliest point at which the next activity can start. So it's the earliest start time for D. D can't begin until both A and C have been completed, because A and C feed into that third node. Well, if A takes 3 weeks and B and C takes 2 weeks, you can't start D until A's been finished. So you go with the longest one because you can't start D until both. I don't know what A is. It's a made-up example. Maybe A is really important to doing D. So we're going to use the largest number. And then the rest of this is going to be pretty straightforward because there's no multiples. But 3 plus 2 is 5. 5 plus 1 is 6. 6 plus 1 is 7. So what we've identified there is that this entire project takes 7 weeks. So you might have a deadline for this. It might be the deadline was 8 weeks, in which case we're great. If the deadline was 5 weeks, we're in a bit of trouble here. So the next step is to identify the critical path. And the critical path is the longest path to get to the end of the project. And what this is this shows which activities can't be delayed without delaying the entire thing. That's why these activities are critical. It's critical that they get done on time. So the longest path to get us to the end of the project was A, D, E, F. B and C weren't on that because they didn't contribute to that number 7. It was A, 3, D, 2, E, 1, F, 1. 3 plus 2 plus 1 plus 1. We can show this on the graph by just putting these little hash marks on those lines. So, I mean, that's kind of how you identify that that's on the critical path. What that means is none of those activities can be delayed. A, D, E, and F. If they're delayed, the entire project's delayed. So if E, for example, took 3 weeks instead of 1, well, that means you're not going to be able to start F until 8 weeks, which means you're going to finish on 9 weeks instead of 7 weeks. So these can't be delayed. The third step to this is to calculate the latest finish times. This is I think this is the one that students struggle with the most, and I understand it because you've just been thinking about the start time for the next project. You're now going to think about the finish time for the previous project. I guess the key trick is to just do what you did for the earlier start times, but in reverse. So we're going to go from right to left. We're going to subtract, and we're going to use the smallest total. So drop the 7. You see this in red to make it clear, make it easy. 7 minus 1 is 6. 6 minus 1 is 5. 5 minus 2 is 3. And then here we've got, obviously, to get to 0, we've got 2 paths going backwards. So we're going to do 3 minus 1 is 2. And then we've got 2 options into getting into node 1. We've got 3 minus 3 is 0. 2 minus 1 is 1. Remember, we're going with the smallest node total, so we're going to go with 0. Now, the trick here, or the hint, I guess, is that all of the nodes on the critical path, which is nodes in this situation, 1, 3, 4, 5, and 6, they will have the same earlier start time as and latest finish time because there's no delaying any of these. They've got to be right on time. Whereas node 2 isn't on the critical path, so there is going to be a difference between the earlier start time and the latest finish time in that node. What that allows us to do is it allows us to identify whether there is any float time. So students can quite often get their head around critical path analysis, but in doing so, will forget about the float time. It's in the same way that students can get their head around break even and then forget about margin of safety. And so they think they know break even and do, but then margin of safety comes up and suddenly it's like, hold on, I've forgotten all about that. Float time is that for critical path. The float time is basically the slack time there is for an activity that can be delayed. All of the activities on the critical path, we've already established they can't be delayed, so there's no float time. And you can do this calculation, and the answer would just be 0. So the calculation is just on the bottom right corner there, the latest finish time for that activity minus the duration of that activity minus the earliest start time for that activity. The key thing here is you need to take the finish time from the finish of that activity, so the end of that activity, and then the start time from the start of that activity. So if we took, for example, D, the finish time for D is 5, that red 5 in node 4. The duration is 2. The start time for node 3 is 3. So you do 5 minus 2 is 3, minus 3 equals 0. There is only 2 activities on this whole project that can have float time. They're the ones that are critical. So we've got B and C. So let's calculate the float time for B and C. So B, the latest finish time is 2. That's at the finish of B. So that node 2 red number. So 2 minus 1 minus 0. 2 is the latest finish time, 1 is the duration, 0 is the start time at the start of B. 2 minus 1 equals 0 is 1 float. So that means there's 1 week of float time. So B could be delayed by a week, and that would be absolutely fine. That wouldn't affect the long-term deadline of the project. C also has a float time of 1. 3 minus 1 minus 1 equals 1 float time. One thing that's worth bearing in mind here is it's quite clear that that little section there, B and C takes 2 weeks, A takes 3 weeks, so of course they have 1 float week. They could be 1 delayed. If B is delayed by a week, C no longer has float time. Because if B is delayed by a week, 2 plus 1 is 3. So if that's delayed, that becomes critical. If those activities that have float time are delayed by more than their float time, or by their float time, they will become critical activities where they can't be delayed. Again, with that, the best thing you can do is do some practice. Have a look at the questions on past exam papers. To be honest, with the critical path activities, the examples that they give you are pretty linear. They're pretty easy to follow, so it's well worth having a look at those. If you've got any questions, chuck them in the comments. And it goes without saying, obviously, this is not a comprehensive recap. This is just a bit of a review to just check that you kind of know what you're talking about. And hopefully you do. If you've got any questions, chuck them in the comments. And check out the other videos. By time you see this one, all of Theme 3 will be available. And so all Theme 1, 2, 3, and 4 are all linked in the comments. So make sure you check them all out as part of your revision. And if you're preparing for Paper 2, then have a look at the preparing for Paper 2 video as well, which is also on the channel. Okay? See you next time.